Chapter 1. The 32,000 crore rupees question. The story behind Satin Creditcare Network. Imagine you're an investor searching for the next long-term wealth creator. Where would you look? Would you start with India's biggest banks? Or would you look where most investors rarely pay attention? The villages, small towns, and first-time entrepreneurs who form the backbone of India's economy? Because sometimes the biggest investment opportunities don't begin in boardrooms. They begin with a simple problem. A vegetable vendor wants to buy a larger cart. A dairy farmer wants to mow cows. A woman running a tailoring business wants another sewing machine. A small shopkeeper needs money to stock inventory before the festive season. None of them needs 10 crore rupees. Most don't even need 10 lakh rupees. They simply need 30,000 rupees, 50,000 rupees, or maybe 1 lakh rupees. Small amounts. But for them, these loans can completely change their income. Now here's where things become interesting. If thousands of people borrow such small amounts, it doesn't create a large business. But if millions of people do, it creates one of the largest lending markets in the country. So why don't banks lend to everyone? It's not because they don't want to. It's because very small loans are expensive to manage. Whether a bank lends 50,000 rupees or 50 crore rupees, it still has to verify documents, process applications, monitor repayments, and comply with regulations. For tiny loans, those administrative costs become relatively high. Many borrowers also have little or no formal credit history. The record lenders use to judge whether someone has repaid previous loans responsibly. As a result, traditional banks often find it difficult to serve this segment profitably. And that's where an entirely different industry emerged. It is called microfinance. Let's simplify that. Microfinance is a business that provides small loans to individuals and tiny businesses who may not have access to traditional bank credit. Instead of financing large corporations, these institutions finance everyday entrepreneurs. A tailor, a farmer, a food stall owner, a dairy operator, a home-based manufacturer. One loan may be small, but millions of such loans together create a massive business. This market has expanded rapidly over the past 2 decades. Why? Because India's economy isn't driven only by large listed companies. It is also powered by millions of micro and small entrepreneurs. Every time one of these businesses expands, someone buys more raw material. Someone hires another worker. Someone earns a higher income. Someone spends more in the local economy. That is why economists often say, credit is the fuel of economic growth. Without access to finance, many good business ideas never become successful businesses. Now imagine a company that has spent decades building relationships with exactly these borrowers. Not in one state, not in 10 districts, but across thousands of villages throughout India. That company is Satin Creditcare Network Ltd. For many years, Satin built its business primarily through microfinance. But management eventually recognized an important challenge. Depending on a single line of business can make a company more vulnerable. If regulations change, if competition intensifies, or if borrowers face temporary financial stress, growth can slow dramatically. Great businesses prepare for those risks before they become problems. So Satin decided to evolve. Instead of remaining only a microfinance lender, it began building a broader rural financial services platform. Think of it this way. Imagine a restaurant famous for serving only one dish. The dish is popular. Customers love it. But management knows that relying on a single product is risky. So gradually, they add new dishes. Not because the old one is failing, but because they want customers to have more reasons to return. Satin is attempting something similar. Today, alongside microfinance, it is expanding into housing finance, loans to buy or improve homes, MSME lending, loans to small and medium-sized businesses, and other financial services designed for rural and semi-urban India. The ambition is significant. Management has increased its FY 2030 target for assets under management, or AUM, from 25,000 crore rupees to 32,000 crore rupees. Let's pause for a second. Assets under management, AUM, simply means the total value of all loans currently outstanding that the company manages. Think of it as the size of Satin's lending book. A larger AUM generally means a larger business, but only if those loans are repaid responsibly. At the same time, the company aims to increase the share of its non-microfinance business from around 17% today to nearly 30% by FY 2030, reducing its dependence on a single source of revenue. This strategy is outlined in the company's long-term growth roadmap. Now the investment question becomes far more interesting. Is Satin merely a microfinance company? Or is it quietly transforming into a diversified rural financial institution before the market fully recognizes that change? Because in investing, the biggest returns often come not from buying great companies after everyone agrees they're great, but from identifying a business that is becoming great while most investors still see the old story. And that's exactly the question we'll investigate in this documentary. Not whether Satin is a good company, but whether its future is likely to be much bigger than its past. Chapter 2. The Invisible Economy That Banks Couldn't Reach. You're listening to Story Behind Stocks, where every company has a story worth understanding. Before we meet today's business, let's first understand the world it operates in. Imagine you are the chairman of a large bank. Every morning, hundreds of loan applications arrive on your desk. Most belong to established businesses. They own factories, offices, land, machinery, and years of financial records. If they fail to repay, the bank can recover its money by selling those assets. Now imagine another application. It comes from a woman living in a small village. She runs a tiny tailoring shop from her home. She earns enough to feed her family, but dreams of buying another sewing machine so she can double her income. She has never filed a balance sheet, owns no expensive property, and has no credit history, a record that shows how responsibly someone has borrowed and repaid money in the past. To a traditional bank, she appears risky. But is she really? Every day she works, earns, saves, and supports her family. Her business is real. Her customers are real. The only thing missing is access to formal finance. For decades, this was one of India's biggest economic contradictions. Millions of hardworking people wanted to build businesses, yet they remained invisible to the banking system. Not because they lacked ambition, but because they lacked documents, collateral, and formal financial records. Collateral simply means an asset, such as land, a house, or machinery that a borrower pledges to the lender. If the borrower cannot repay the loan, the lender has the legal right to sell that asset and recover the money. Most low-income entrepreneurs have no such assets. Without collateral, banks preferred not to lend. As a result, many families turned to local money lenders who often charged interest rates so high that borrowers remained trapped in debt instead of escaping poverty. This is the problem that microfinance was created to solve. Microfinance simply means providing small loans and other financial services to people who are excluded from the traditional banking system. The loans are usually modest in size, but their impact can be transformational. A loan may help a dairy farmer buy another cow. A vegetable vendor may purchase a larger cart. A tailor may buy a second sewing machine. A small grocery shop may increase its inventory before the festive season. These are not glamorous businesses. Yet together, they form one of the largest economic engines in India. If India's economy were a giant tree, large listed companies would be its trunk. Medium-sized businesses would be its branches. But the roots, the part that quietly keeps the entire tree alive, are millions of small entrepreneurs spread across villages, towns, and semi-urban India. They rarely appear on television. They seldom make headlines. Yet they generate employment, create local demand, and keep rural consumption moving. Like every tree, those roots need nourishment. For businesses, that nourishment is capital. Capital is simply money used to grow a business. It helps entrepreneurs buy equipment, inventory, livestock, vehicles, or anything that increases their ability to earn more income. Without capital, even the hardest working entrepreneur can only grow so far. Over the last 2 decades, India has witnessed one of the world's largest financial inclusion journeys. Financial inclusion means ensuring that every individual, regardless of income, education, or location, has access to essential financial services such as savings accounts, loans, insurance, and digital payments. Government initiatives, digital identity through Aadhaar, mobile banking, UPI payments, and expanding banking infrastructure have brought millions of Indians into the formal financial system. But opening a bank account is only the beginning. Economic progress requires access to credit. And this is where the real opportunity begins. As incomes rise, the financial needs of borrowers also evolve. A woman who first borrowed 30,000 rupees to start a tailoring business may later need 2 lakh rupees to expand into a garment store. Years later, she may require a housing loan to build her own home or a business loan to employ more workers. Her journey doesn't end with one loan. It grows with her ambitions. This changing customer journey is quietly reshaping India's lending industry. The most successful lenders are no longer satisfied with offering just one type of loan. Instead, they are building lifelong relationships with customers by serving multiple financial needs as incomes increase. This creates a much larger business opportunity. Instead of earning from a single loan, lenders can continue serving the same customer through different stages of life. It also reduces business risk. Think of it like farming. A farmer growing only one crop depends entirely on that crop succeeding. A drought or pest attack can destroy his entire income. But another farmer grows wheat, vegetables, fruits, and also owns dairy cattle. Even if one source of income struggles, the others continue generating cash. Financial companies follow the same principle. A lender depending entirely on one category of loans is exposed to greater risk if that segment faces economic or regulatory challenges. A diversified lender spreads its business across multiple products and customer segments, making its earnings potentially more stable over time. This is exactly the transformation Satin Creditcare is attempting. The company began primarily as a microfinance institution, but management now wants to become a broader rural financial services company. Rather than serving customers only during the earliest stage of their financial journey, Satin aims to grow alongside them by offering products such as MSME loans for small businesses, housing finance, and other forms of rural credit. The numbers already show this transition. According to the company's FY26 investor presentation, businesses outside traditional microfinance contributed only about 5% of Satin's assets under management, or AUM, in FY 2019. Assets under management refers to the total value of all loans currently outstanding on the company's books. By FY 2026, that share had increased to 17%, and management has publicly stated its ambition to increase it further to 30% by FY 2030, while targeting an overall loan book of approximately 32,000 crore rupees. These figures indicate that Satin is gradually transforming from a single product lender into a diversified financial institution. For investors, this distinction is crucial. Buying a stock is never just about evaluating today's business. It is about understanding what that business could become over the next decade. And before deciding whether Satin Creditcare deserves a place in an investor's portfolio, we must answer a much more important question. How exactly does this company make money? Because only after understanding its business model can we judge whether its future growth story is built on a strong foundation or merely on ambitious promises. Chapter 3. The Business Model: How Satin Creditcare Really Makes Money. This deep dive is brought to you by Story Behind Stocks. We've understood why rural finance matters. Now let's step inside Satin Creditcare and discover how this business actually creates value. Imagine walking into a bank with a simple request. You ask for a loan of 1 lakh rupees to expand your business. The bank doesn't manufacture that money. It isn't printing currency in the basement. Instead, it first raises money from depositors or borrows it from other financial institutions. It then lends that money to you at a higher interest rate. The difference between what the bank pays to obtain the money and what it earns by lending it is one of the primary ways banks generate profits. Satin Creditcare operates on the same fundamental principle. It doesn't manufacture cars or sell mobile phones. Its product is money itself. Every day, the company borrows funds from banks, development finance institutions, and the debt market. It then lends those funds to millions of borrowers, primarily women in rural and semi-urban India. The interest earned on these loans becomes the company's largest source of income. At first glance, this may seem like a very simple business. Borrow at one price, lend at a higher price, earn the difference. But if that were the entire story, every lender would become enormously profitable. The real challenge lies elsewhere. The company must ensure that borrowers repay their loans on time. If too many borrowers fail to repay, the interest income quickly disappears and losses begin to mount. This is why lending is often described as a business of managing risk, not merely distributing money. This is the first lesson every investor should understand about Satin Creditcare. The company is not selling loans. It is selling trust. Every loan that Satin approves represents a judgment that the borrower has both the ability and the willingness to repay. The better those judgments are, the stronger the business becomes over time. For many years, Satin was known almost entirely as a microfinance institution, commonly called an MFI. A microfinance institution is a financial company that provides very small loans to people who usually do not have access to traditional banking services. These borrowers are often small shopkeepers, vegetable vendors, dairy farmers, artisans, or women running home-based businesses. Since they generally do not own substantial assets to pledge as collateral, the lender relies heavily on the borrower's repayment history, local relationships, and community discipline. This business transformed Satin into one of India's largest rural lenders. However, management recognized an important limitation. Imagine a young woman who borrows 40,000 rupees to buy a sewing machine and starts a tailoring business. Over the next 5 years, her business grows steadily. She now needs 5 lakh rupees to expand her workshop. A few years later, she wants to purchase her family's first house. If Satin only offers microfinance loans, it would lose this customer just when her financial journey becomes more meaningful. Instead of allowing that to happen, the company decided to evolve alongside its customers. That decision gradually transformed Satin from a single product lender into a broader financial services platform. Today, the group operates several businesses, each serving a different stage of a customer's financial life. One business continues to provide microfinance loans. Another focuses on housing finance, which simply means lending money to individuals to buy or construct homes. A third business finances MSMEs, or micro, small and medium enterprises, the small businesses that form the backbone of India's economy. Satin has also entered the asset management business through an alternative investment fund and has built a technology subsidiary that develops software, artificial intelligence solutions, cybersecurity systems, and digital banking platforms for financial institutions. None of these businesses were added randomly. Together, they form a connected ecosystem where the company hopes to retain customers as their income, aspirations, and borrowing requirements increase over time. This is a subtle but important shift. Instead of repeatedly spending money to acquire new customers, Satin aims to deepen its relationship with existing ones. For investors, this matters because serving an existing customer is generally cheaper and less risky than constantly searching for new borrowers. Management's long-term strategy reflects this evolution. A few years ago, almost the entire business depended on microfinance. According to the company's FY26 investor presentation, non-microfinance businesses contributed only around 5% of assets under management in FY 2019. By FY 2026, that share had increased to approximately 17%, and management has articulated an ambition to increase it to nearly 30% by FY 2030. Before moving further, it is worth understanding one important financial term. Assets under management, often abbreviated as AUM, represents the total value of loans that are currently outstanding and generating income for the lender. Think of it as the size of the company's active loan book. A growing AUM generally indicates that the company is expanding its lending business, although investors must always examine whether this growth is being achieved responsibly. For an investor, this diversification tells an important story. Imagine an airline operating only one route between two cities. If passenger demand weakens, the entire business suffers. Now imagine another airline flying hundreds of profitable routes across the country. A slowdown in one region has a much smaller impact because revenue comes from many different sources. Satin is attempting something similar. Instead of depending entirely on one category of lending, it is gradually building multiple engines of growth. If executed well, this could reduce dependence on any single segment and create a more resilient business over the long term. Another aspect that deserves an investor's attention is technology. Whenever companies mention artificial intelligence, investors often become either overly excited or completely skeptical. The reality usually lies somewhere in between. Artificial intelligence cannot eliminate credit risk, nor can it magically guarantee profits. However, it can significantly improve decision-making. Imagine a credit officer manually evaluating thousands of loan applications every week. Human experience is valuable, but humans naturally become slower, inconsistent, and more prone to errors as the workload increases. Now imagine software capable of analyzing years of repayment behavior, identifying unusual borrowing patterns, detecting early warning signs of financial stress, and helping loan officers make better-informed decisions. That is where technology creates real value. According to the FY 26 investor presentation, Satin has been investing in proprietary technology platforms, artificial intelligence-based underwriting, portfolio monitoring, cybersecurity, and data analytics to strengthen both operational efficiency and risk management. These investments are intended to improve lending decisions while reducing operational costs over time. For investors, technology should never be viewed as a guarantee of success. Instead, it should be viewed as a tool that enhances execution. Good technology cannot compensate for poor lending discipline, but good technology combined with disciplined management can become a meaningful competitive advantage. Perhaps the company's greatest strength is something far less glamorous than artificial intelligence. It is its physical presence. By the end of FY 2026, Satin operated more than 2,000 branches across India, served nearly 34 lakh active customers, and employed over 18,000 people. At first, these numbers may appear to be nothing more than corporate statistics. In reality, they represent years of accumulated relationships, local knowledge, and borrower trust. Every repayment collected, every customer interaction, and every successful loan builds a database that becomes increasingly difficult for a new competitor to replicate. In lending, scale is not merely about becoming bigger. It is about becoming smarter. The more responsible borrowers a lender serves, the more experience it gains in understanding who is likely to repay and who is not. That accumulated knowledge gradually becomes one of the company's most valuable intangible assets. As investors, we should now begin to see Satin Creditcare differently. This is no longer just a company that lends small amounts of money to rural borrowers. It is attempting to build an integrated financial ecosystem that supports customers from their first microloan to housing finance, business expansion, and, eventually, a broader range of financial products. Whether this ambitious vision ultimately succeeds will depend not on presentations or promises, but on execution. And execution always begins with one question: Who are the people making the decisions? That is exactly where our story goes next. Chapter 4. The people steering the ship. This business story is brought to you by Story Behind Stocks. Behind every successful company isn't just capital or technology. It's a management team making thousands of decisions that most investors never see. A great business can survive a bad year, but very few businesses survive bad management. Imagine you have 10 lakh rupees to invest. Two friends approach you. The first says, "Give me your money. I'll work hard and hopefully earn a good return." The second says, "Before you invest, let me explain exactly where every rupee will go, how much risk I'll take, what returns I expect, and how I'll protect your money if things go wrong." Whom would you trust? Most people would choose the second person, not because he promised higher returns, but because he demonstrated something far more valuable: judgment. The stock market works exactly the same way. When we buy shares of a company, we are not simply buying buildings, computers, or loan books. We are placing our trust in a group of people who decide where thousands of crores of shareholders' money should be invested. Those people are called the management team. Think of management as the captain of a ship. The ship may be strong, the sea may be calm, and the destination may be attractive. But if the captain makes poor decisions, even the best ship can lose its way. Likewise, an average business led by exceptional managers often creates far greater wealth than an excellent business run by poor managers. That is why legendary investor Warren Buffett often says he prefers investing in businesses managed by honest and capable people. The question, therefore, is not whether Satin Creditcare operates in a promising industry. The real question is, can its management convert opportunity into long-term shareholder wealth? To answer that, we need to understand what the management is trying to build. A change in identity that most investors overlook. If you compare Satin Creditcare's recent investor presentations with those of a few years ago, one subtle but important change immediately stands out. The company no longer describes itself merely as a microfinance institution. A microfinance institution, often abbreviated as MFI, is a company that provides very small loans to people who usually do not have access to traditional bank credit. These borrowers are often self-employed individuals, small shopkeepers, artisans, or women running household businesses in rural and semi-urban India. For many years, this was Satin's primary identity. Today, however, management increasingly describes Satin as a rural financial services company. At first glance, this may appear to be just a change in terminology. It isn't. It signals a much bigger shift in strategy. Imagine a neighborhood grocery store deciding that it no longer wants to remain just a grocery shop. Instead, it wants to become a complete supermarket where customers can buy groceries, medicines, household goods, electronics, and clothing all under one roof. The customer may still enter through the same door, but the business has fundamentally changed. That is exactly what Satin's management appears to be attempting. Rather than depending on a single product, small group loans, the company wants to become a financial partner for customers as their financial needs grow. This broader strategy includes expanding into housing finance, loans for small businesses, financing for productive assets, and other financial services. The management has also increased its long-term growth target, aiming to grow its assets under management to 32,000 crore rupees by FY 2030 while increasing the share of non-microfinance businesses to nearly one-third of the overall portfolio. Before we discuss whether these ambitions are achievable, we need to understand another concept that separates extraordinary management teams from ordinary ones. That concept is called capital allocation. Chapter 5. When numbers start telling the truth. We've now understood what Satin Creditcare does, how it earns money, and why management believes the future looks promising. But every company tells a good story. The real question is, does the story survive when we open the financial statements? Think about meeting someone for the first time. They may speak confidently. They may dress well. They may tell you about their ambitions and future plans. But if you really wanted to know whether that person manages money wisely, you wouldn't listen to their speeches. You would quietly look at their bank statement. A company's financial statements serve the same purpose. They don't tell us what management hopes to achieve. They tell us what the business has actually achieved. For long-term investors, this is where opinions end and evidence begins. So let's open Satin Creditcare's financial statements and see what they reveal. The very first number investors usually look at is revenue. Revenue simply means the total income generated from the company's normal business activities before paying any expenses. Imagine you own a grocery store. If customers buy groceries worth 10 lakh rupees during a month, then 10 lakh rupees becomes your revenue. It doesn't matter whether you made a profit or a loss. Revenue simply measures how much business came through your doors. For a lending company like Satin Creditcare, revenue mainly comes from the interest it earns by lending money to borrowers. When more customers borrow loans and continue repaying them on time, revenue usually grows. And that's exactly what Satin has been experiencing. Over the last few years, its revenue has almost doubled, rising from around 1,549 crore rupees in FY23 to over 3,100 crore rupees in FY26. This tells us something important. More people are borrowing from Satin. Its loan book is expanding. Its presence across India is becoming larger. In simple words, the business itself is growing. But experienced investors know that revenue can sometimes be misleading. A company can increase sales simply by cutting prices, taking excessive risks, or spending heavily on expansion. Growth alone doesn't guarantee that shareholders become richer. That's why investors immediately move to the second question. Is the company actually making more money? This is where we encounter another important financial term, profit after tax, often called PAT. Profit after tax is exactly what its name suggests. After paying salaries, rent, borrowing costs, operating expenses, provisions for bad loans, and taxes, whatever finally remains belongs to the shareholders. Think of it as your monthly salary. Suppose you earn 1 lakh rupees every month. After paying your rent, school fees, groceries, electricity bills, EMIs, insurance premiums and income tax, perhaps only 25,000 rupee remains. That remaining amount is your real savings. A company's profit after tax works in exactly the same way. For Satin, this final profit has grown sharply. The company reported around 332 crore rupees of profit in FY26, nearly 80% higher than the previous year. Now that's encouraging, because the company isn't merely becoming bigger, it is becoming more profitable. And when profits grow faster than revenue, investors begin asking another fascinating question. How efficiently is the company earning those profits? Imagine two restaurants located next to each other. Both generate sales of 100 rupees every day. The first restaurant spends 95 rupees on ingredients, salaries, and electricity. The second spends only 75 rupees. Although both restaurants have identical sales, the second restaurant earns much more profit. This difference is called a margin. A margin tells us how much of every rupee earned is ultimately retained by the business instead of being spent. For banks and NBFCs, one of the most important margins is called the net interest margin, or simply NIM. The name sounds technical, but the idea is surprisingly simple. Imagine borrowing money from your friend at 8% interest and lending it to someone else at 15%. The difference between what you earn and what you pay is your spread. That spread is what keeps your business alive. For lending institutions, this spread is called the net interest margin. The larger the margin, the more efficiently the lender is converting borrowed money into earnings. During FY26, Satin maintained a healthy net interest margin of about 13.2%, indicating that the company continues to earn a comfortable spread between its lending rates and borrowing costs. But that naturally raises another question. Where does Satin get the money that it lends? Unlike individuals, NBFCs don't create money. They borrow it. They raise funds from banks, financial institutions and debt markets, and then lend those funds to customers at higher interest rates. Naturally, if Satin can borrow money more cheaply, it can earn higher profits without increasing the interest charged to borrowers. Think of a clothing shop. If one shopkeeper buys shirts from a wholesaler for 500 rupees and another buys the same shirts for 450 rupees, the second shopkeeper enjoys a clear advantage. He can either sell at a lower price or earn a higher profit. The same principle applies to lenders. During FY26, Satin managed to reduce its borrowing cost by around 43 basis points. Now, the phrase basis points often confuses investors. 1 basis point simply means 1/100th of 1%. So, 43 basis points are equal to just 0.43%. That may sound insignificant. But when a company borrows thousands of crores, saving even 0.5% translates into crores of additional profits every year. Sometimes, small percentages create very large outcomes. However, there is one number that experienced investors watch even more carefully than profits. That number is asset quality. The term sounds complicated, but the idea is simple. Imagine lending money to 10 friends. If all 10 repay you, life is easy. But if 3 disappear without returning your money, your profits can disappear overnight. The same risk exists for every lender. Loans are considered the company's assets because they are expected to generate income in the future. But when borrowers stop paying, those assets begin losing value. That's why investors constantly monitor the quality of those assets. For Satin, management reported continued improvement in collection efficiency and a decline in seriously overdue loans. That tells us the company isn't merely growing faster. It is also trying to ensure that the money it lends comes back. Growth without repayment is dangerous. Growth with disciplined collections creates a far stronger business. Finally, investors ask perhaps the most important question of all. How efficiently is management using shareholders' money? This is measured by a ratio called return on equity, or ROE. Think of it as your monthly salary. Suppose you earn 1 lakh rupees every month. After paying your rent, school fees, groceries, electricity bills, EMIs, insurance premiums and income tax, perhaps only 25,000 rupee remains. That remaining amount is your real savings. A company's profit after tax works in exactly the same way. For Satin, this final profit has grown sharply. The company reported around 332 crore rupees of profit in FY26, nearly 80% higher than the previous year. Now that's encouraging, because the company isn't merely becoming bigger, it is becoming more profitable. And when profits grow faster than revenue, investors begin asking another fascinating question. How efficiently is the company earning those profits? Imagine 2 restaurants located next to each other. Both generate sales of 100 rupees every day. The first restaurant spends 95 rupees on ingredients, salaries, and electricity. The second spends only 75 rupees. Although both restaurants have identical sales, the second restaurant earns much more profit. This difference is called a margin. A margin tells us how much of every rupee earned is ultimately retained by the business instead of being spent. For banks and NBFCs, one of the most important margins is called the net interest margin, or simply NIM. The name sounds technical, but the idea is surprisingly simple. Imagine borrowing money from your friend at 8% interest and lending it to someone else at 15%. The difference between what you earn and what you pay is your spread. That spread is what keeps your business alive. For lending institutions, this spread is called the net interest margin. The larger the margin, the more efficiently the lender is converting borrowed money into earnings. During FY26, Satin maintained a healthy net interest margin of about 13.2%, indicating that the company continues to earn a comfortable spread between its lending rates and borrowing costs. But that naturally raises another question. Where does Satin get the money that it lends? Unlike individuals, NBFCs don't create money. They borrow it. They raise funds from banks, financial institutions, and debt markets, and then lend those funds to customers at higher interest rates. Naturally, if Satin can borrow money more cheaply, it can earn higher profits without increasing the interest charged to borrowers. Think of a clothing shop. If one shopkeeper buys shirts from a wholesaler for 500 rupees and another buys the same shirts for 450 rupees, the second shopkeeper enjoys a clear advantage. He can either sell at a lower price or earn a higher profit. The same principle applies to lenders. During FY26, Satin managed to reduce its borrowing cost by around 43 basis points. Now, the phrase basis points often confuses investors. 1 basis point simply means 1/100th of 1%. So, 43 basis points are equal to just 0.43%. That may sound insignificant. But when a company borrows thousands of crores, saving even 0.5% translates into crores of additional profits every year. Sometimes, small percentages create very large outcomes. However, there is one number that experienced investors watch even more carefully than profits. That number is asset quality. The term sounds complicated, but the idea is simple. Imagine lending money to 10 friends. If all 10 repay you, life is easy. But if 3 disappear without returning your money, your profits can disappear overnight. The same risk exists for every lender. Loans are considered the company's assets because they are expected to generate income in the future. But when borrowers stop paying, those assets begin losing value. That's why investors constantly monitor the quality of those assets. For Satin, management reported continued improvement in collection efficiency and a decline in seriously overdue loans. That tells us the company isn't merely growing faster. It is also trying to ensure that the money it lends comes back. Growth without repayment is dangerous. Growth with disciplined collections creates a far stronger business. Finally, investors ask perhaps the most important question of all. How efficiently is management using shareholders' money? This is measured by a ratio called return on equity, or ROE. Imagine you and your friend each invest 100 rupees in separate businesses. At the end of the year, your business earns 20 rupee while your friends earns only 10 rupees. You both invested the same amount, yet one business generated twice the profit. That is exactly what return on equity measures. It tells investors how much profit management generates from every rupee invested by shareholders. During FY26, Satin reported an ROE of around 12.3%, while its return on assets, or ROA, stood at approximately 2.6%. Return on assets is another efficiency measure. Instead of looking only at shareholders' money, it measures how effectively the company earns profits from everything it owns and controls, including money borrowed from lenders. For financial companies, even a small improvement in ROA can have a meaningful impact because they operate on very large balance sheets. So, what is the overall picture? When we connect all these numbers instead of looking at them in isolation, a clear story begins to emerge. Satin Creditcare is lending more money than before. Its revenue is growing. Its profits are rising even faster. Its borrowing costs are gradually coming down. Its loan collections remain stable. And management is becoming more efficient at generating returns from the capital entrusted to it. None of these numbers, by themselves, guarantee that Satin will become a successful investment. Markets are never that simple. But together, they suggest that the business is moving in the right direction. And that brings us to one of the most fascinating questions in investing. If the business is improving, why doesn't the stock price always rise immediately? Because the stock market doesn't just reward good businesses. It rewards businesses when improving fundamentals finally change investor perception. That is exactly the story we'll uncover in the next chapter. Chapter 6. Why some companies make investors rich and others don't. This documentary is brought to you by Story Behind Stocks. We've explored the industry, the business model, the management team, and the financial statements. Now comes the most important question in investing. Why do some companies create extraordinary shareholder wealth while others, despite showing profits, remain ordinary investments? Imagine you have 10 lakh rupees to invest. You meet two business owners. The first tells you, "Give me your money. Every year I'll earn a profit, but I'll distribute almost everything back to you." The second says, "I'll also earn a profit, but instead of taking it out, I'll use it to open more branches, serve more customers, improve technology, reduce costs, and make even bigger profits in the future." At first glance, both sound equally attractive. Both are profitable. Both are growing. Both are honest businesses. Yet, 20 years later, one investment may have multiplied 50 times, while the other has barely doubled. What created such a massive difference? The answer is surprisingly simple. The second business understood the power of compounding. Compounding is often called the eighth wonder of the world, but in reality, it is a very simple idea. Instead of consuming today's profits, a business reinvests them to generate even larger profits tomorrow. Those larger profits are again reinvested, creating an ever-growing cycle of expansion. Just as a tiny snowball rolling down a mountain gathers more snow with every turn until it becomes enormous, great businesses allow their profits to continuously build upon themselves. This is the foundation of long-term wealth creation. It is also the principle that separates companies' investors merely trade from companies' investors proudly own for decades. But there is another ingredient that is equally important: management. A mediocre management team can destroy an excellent business. An exceptional management team can transform an ordinary business into an extraordinary one. That is why successful investors spend as much time studying the people running the company as they do studying its financial statements. Financial statements tell you what happened. Management tells you what is likely to happen next. And in investing, the future is what determines today's value. As we have seen throughout Satin Creditcare's journey, the company is no longer trying to remain just another microfinance institution. It is attempting something much larger. Its ambition is to become a diversified rural financial services company. That may sound like corporate jargon, so let's simplify it. Imagine a farmer who grows only wheat. If the wheat crop fails because of poor rainfall or disease, the farmer's entire income disappears. Now imagine another farmer. He grows wheat, vegetables, fruits, and keeps dairy cattle. Even if one crop performs poorly, the others continue generating income. His earnings become more stable. His risks reduce. His future becomes more predictable. Businesses operate in exactly the same way. A company that depends on only one source of income is vulnerable. A company with multiple profitable businesses is usually more resilient because weakness in one segment can be offset by strength in another. This is precisely the direction Satin Creditcare has chosen. For years, the company was known primarily for microfinance. Microfinance simply means providing small loans to people who are often ignored by traditional banks because they lack formal income documents or valuable collateral. These borrowers are usually small shopkeepers, farmers, self-employed workers, and women entrepreneurs running tiny businesses. Microfinance gave Satin a strong foundation. But management realized that depending entirely on one business would eventually limit future growth. Instead of remaining a single product lender, the company has gradually expanded into MSME lending, housing finance, sustainable finance, insurance distribution, and fee-based financial services. An MSME, or micro, small and medium enterprise, is simply a small business, such as a manufacturing unit, repair workshop, trading company, or service provider that forms the backbone of India's economy. These businesses often require loans to purchase machinery, expand operations, or hire more employees. Housing finance, on the other hand, provides loans that help families purchase or construct homes. Each of these businesses serves different customer needs. More importantly, they generate income from different economic activities. Management expects this diversification to significantly reduce dependence on any single lending segment over the coming years. But expanding into multiple businesses creates another challenge. Growth by itself has never guaranteed success. Anyone can grow by lending aggressively. The real challenge is ensuring that borrowers repay. Think of lending like giving seeds to hundreds of farmers. If most farmers cultivate successful crops and return both the seeds and a share of the harvest, everyone benefits. The lender now has even more seeds to distribute next season. But if a large number of farmers fail to repay, the original stock of seeds begins disappearing. Eventually, there are not enough seeds left to continue farming. Banks and finance companies face the same reality. Every loan is an investment. Every repayment allows fresh lending. Every default permanently destroys part of the company's capital. This is why experienced investors closely monitor something called asset quality. Despite its technical name, asset quality is actually very easy to understand. For a lender, an asset is simply the money it has lent to customers. If borrowers repay regularly, those assets remain healthy. If repayments stop, those assets become stressed and profits begin to suffer. Healthy asset quality means the company is lending to the right people and collecting repayments successfully. Poor asset quality usually indicates that management has taken excessive risks. Protecting asset quality is therefore not just about avoiding losses. It is about protecting the company's future. And this is where Satin's management has invested heavily. Instead of relying only on traditional methods of evaluating borrowers, the company is increasingly using technology, digital verification, analytics, and artificial intelligence to improve lending decisions. Artificial intelligence, often called AI, refers to computer systems capable of identifying patterns from enormous amounts of data far faster than humans. Rather than replacing experienced loan officers, AI assists them by highlighting risks that may otherwise go unnoticed. The objective is straightforward. Approve loans that are more likely to be repaid. Reject loans that carry unnecessary risk. This entire process is known as underwriting. Underwriting is nothing more than the science of deciding who should receive a loan and under what conditions. Imagine a doctor examining a patient before prescribing medicine. The better the diagnosis, the better the treatment. Similarly, the better the underwriting process, the lower the probability of future loan defaults. Improved underwriting creates healthier borrowers. Healthier borrowers improve asset quality. Better asset quality reduces losses. Low losses increase profits. Higher profits generate more capital for future growth. One disciplined decision quietly creates another. That is how sustainable businesses are built, not through shortcuts, but through thousands of well-made decisions repeated consistently over many years. However, management's ambitions extend beyond simply expanding the loan book. A loan book is the total value of all outstanding loans given by the company. You can think of it as the inventory of a manufacturing company. While a manufacturer stores finished products in warehouse, a finance company stores capital in the form of loans. The larger and healthier the loan book, the greater the opportunity to earn interest income in the future. Satin has publicly outlined an ambitious vision for FY 2030, aiming to substantially increase its assets under management, commonly called AUM. AUM represents the total value of loans currently being managed by the company. In simple words, it measures the size of the lending business. Just as the number of aircraft reflects the scale of an airline, AUM reflects the scale of a lending institution. But experienced investors know that a larger AUM alone does not create shareholder wealth. A bigger loan book built on weak borrowers can become a financial disaster. A slightly smaller loan book built on disciplined lending can generate superior long-term returns. This is why the quality of growth matters far more than the speed of growth. It is also why Satin's management repeatedly emphasizes profitability, technology, diversification, and credit discipline alongside expansion. These are encouraging signs. Targets inspire confidence. Execution creates wealth. History is filled with companies that announced ambitious plans but failed to deliver them. It is equally filled with businesses that quietly exceeded every expectation because management consistently translated promises into results. So the real question for Satin Creditcare is no longer whether management has a compelling vision. The vision is already visible. The real question is whether management can execute that vision while protecting asset quality, maintaining profitability, and earning the trust of both customers and shareholders. Because in the stock market, investors do not pay premium valuations for dreams. They pay for businesses that repeatedly convert dreams into measurable results. And that brings us to perhaps the most important question in Satin Creditcare's entire story. If the management succeeds in executing this transformation, is the market still underestimating what Satin Creditcare could become? That is exactly what we will uncover in the next chapter, where we examine whether the company's current valuation truly reflects its long-term potential, or whether the market is overlooking one of the most significant turnaround stories in India's financial sector. Chapter 7. The market doesn't value companies. It values expectations. If you've stayed with me until this point, you've probably realized something interesting. We have spent time understanding Satin Creditcare's business, its management, its financial performance, and its plans for the future. Yet none of those things alone decide the company's share price. That may sound surprising, but it is one of the biggest lessons every investor eventually learns. Imagine two students appearing for the same examination. Both study equally hard. Both know the syllabus equally well. Both write almost identical answers. Yet when the results are announced, one receives far more appreciation than the other. How can that happen? Because people don't judge only the final result. They also judge what they expected before seeing the result. If everyone believed the first student would score 95 marks, getting 90 feels disappointing. But if nobody expected much from the second student and he scores 90, everyone celebrates. The performance is identical. Only the expectation was different. The stock market behaves in exactly the same way. A company's share price is not determined only by how much money the business earns today. It is influenced even more by what investors collectively believe that company can earn tomorrow. This is why the market sometimes appears confusing. A company may report excellent profits, yet its share price falls. Another company may report only modest profits, yet its stock jumps sharply. The difference often lies in expectations. The market is constantly asking one question: will tomorrow be better than today? That single question moves billions of rupees every trading session. To understand this better, imagine a new shopping mall being built in your city. For nearly a year, all you can see is dust, construction material, cranes, and workers. To someone driving past every day, it appears as though nothing meaningful is happening. But beneath the ground, engineers are laying the foundation, installing pipelines, electrical wiring, and structural supports. These are invisible activities, yet they determine whether the building will stand for decades. Businesses also pass through similar phases. Long before investors become excited, management quietly strengthens the business from within. Processes improve, costs reduce, technology becomes better, employees become more productive, customers become happier. These improvements may not immediately appear in the share price, but they slowly strengthen the company's foundation. This is exactly what long-term investors try to identify. They are less interested in today's headlines and more interested in whether the business itself is becoming stronger. For several years, Satin Creditcare was not among the market's favorite companies. The entire microfinance industry was facing difficult conditions. Before understanding Satin's situation, let's understand what microfinance actually means. Microfinance simply refers to providing small loans to people who usually cannot borrow easily from large commercial banks. These borrowers are often small shopkeepers, self-employed workers, rural households, or women running tiny businesses. While each individual loan is small, millions of such loans together create a very large lending business. During and after the pandemic, many borrowers across the industry faced financial stress. Some could not repay their loans on time. At the same time, regulators introduced new rules, and investors became worried about whether microfinance companies would continue growing profitably. When investors become worried, they demand a lower price for owning shares. This is why even good businesses sometimes trade at depressed valuations. A valuation simply means the price investors are willing to pay for a company's future earnings. Think of it like buying a house. The house itself may not have changed. But if everyone believes property prices will fall, buyers offer less money. The building is the same. Only people's expectations have changed. Exactly the same thing happens in the stock market. But something interesting often happens while most investors are looking elsewhere. The business quietly starts improving. Management tightens lending standards, which simply means it becomes more careful while deciding whom to lend money to. Better quality borrowers usually reduce future loan defaults. Loan defaults happen when borrowers stop repaying their loans. As fewer borrowers fail to repay, the company's asset quality improves. Asset quality may sound like a complicated banking term, but it simply tells us how healthy a lender's loan book is. Imagine lending money to 10 friends. If all 10 repay you on time, your loan book is healthy. If 4 people stop paying, your loan book becomes weak. Banks and NBFCs measure this continuously because it directly affects their profits. At the same time, Satin also worked on reducing its borrowing costs. Every lending company first borrows money from banks and financial institutions before lending it to customers. If Satin can borrow at a lower interest rate while continuing to lend responsibly, the difference between what it earns and what it pays becomes larger. That extra difference eventually improves profitability. Profitability simply means how efficiently a company converts its business into profits for shareholders. Alongside this, Satin also expanded beyond traditional microfinance into other lending businesses, reducing dependence on a single source of income. Instead of relying on one engine to pull the entire train, management was gradually adding multiple engines. Each individual improvement may appear small, but together they begin changing the entire direction of the business. This is usually the stage where experienced institutional investors begin paying attention. An institutional investor is not an individual buying a few shares from a mobile trading app. These are organizations such as mutual funds, insurance companies, pension funds, and foreign investment firms that manage thousands or even billions of rupees on behalf of millions of investors. Because they invest such large amounts of money, they cannot afford to make emotional decisions. Before buying a company, they study financial statements, management quality, industry trends, competitors, and long-term risks. Sometimes this research continues for months before they buy even a single share. They rarely chase excitement. Instead, they search for businesses where reality is quietly improving before the broader market notices. That is why institutional buying is often considered an important signal. Not because institutions are always right, but because they usually spend far more time researching a business than the average retail investor. This also explains one of the biggest mistakes made by new investors. Most people believe they should buy stock only after everyone starts talking about it. But by then, much of the opportunity may already have been recognized. The biggest gains in investing often come not when a company becomes famous, but while it is still quietly improving. By the time television debates, newspaper headlines, and social media discussions begin celebrating a company, professional investors may already have been studying it for many months. This doesn't mean retail investors cannot succeed. It simply means they should learn to observe businesses before they become fashionable. That is often where the greatest opportunities hide. Chapter 8. Price is what you pay. Value is what you get. If someone asked you to buy a mango tree, what would you look at? Would you look at how much fruit it produced last year? Or would you look at how much fruit it could produce over the next 20 years? Most people would choose the second option. Because when we buy something that will keep generating value in the future, we are not really paying for its past. We are paying for its future. The stock market works exactly the same way. Yet every day, millions of investors make one simple mistake. They confuse price with value. The price of a stock is easy to see. It flashes every second on your trading screen. If Satin Creditcare is trading at 269 rupees, that is its price. It tells you how much the market is asking for one share today. But value is something entirely different. Value is an estimate of what the business is truly worth based on the money it is expected to earn in the future. Think of it this way. Imagine you own a small grocery store in your neighborhood. Every month, after paying rent, salaries, electricity bills, and all other expenses, the shop leaves you with 1 lakh rupees in profit. Now imagine someone offers to buy your shop. Would you sell it for 1 lakh rupees? Of course not, because the shop doesn't produce profit only this month. It can keep generating profits for many years. Whoever buys it is actually buying those future earnings. That is exactly what happens when you buy a company's shares. You are not buying a piece of paper. You are buying a tiny ownership stake in a business that will hopefully continue earning money long into the future. That is why legendary investor Warren Buffett often says, "Price is what you pay. Value is what you get." It sounds simple, but this one sentence has created more successful investors than hundreds of complicated formulas. So the real question isn't whether Satin's share price is 269 rupees. The real question is this: is the business worth more than 269 rupee per share or less? That is the question every intelligent investor tries to answer. Now, if valuing a business were as easy as valuing a house, investing would be simple. But businesses are different. A house may look almost the same 10 years from now. A business can become twice as large or disappear completely. That is why investors don't only look at what a company earns today. They also try to estimate how fast those earnings can grow. Suppose there are two companies. Both earn 100 crore rupees this year. At first glance, they look identical. But there's one important difference. The first company has stopped growing. It will probably earn around 100 crore rupees every year for the foreseeable future. The second company is expanding rapidly. Every year, its profits are increasing because it is opening new markets, attracting more customers, and becoming more efficient. Which business would you rather own? Almost everyone chooses the second. Not because it earns more today, but because it is likely to earn much more tomorrow. This is why investors often say, the market pays for growth. In simple words, growth means a company's ability to increase its earnings year after year. If a business consistently earns more money every year, investors are usually willing to pay a higher price for owning it. This brings us to another important term that often confuses new investors: valuation. Valuation simply means the market's opinion of what a business is worth today. It is not an exact science. Different investors can value the same company differently, just as two people can disagree about the price of a house. One buyer may think a property is worth 80 lakh rupees. Another may happily pay 1 crore rupees because he believes the neighborhood will develop rapidly in the future. Both are looking at the same house, but they have different expectations about its future. The stock market works in exactly the same way. Every share price represents millions of investors collectively trying to answer one question: what do we think this business will become in the future? That is why valuation constantly changes. Not because the company changes every day, but because investors' expectations change every day. And this is where Satin Creditcare's story becomes interesting. If you look only at today's numbers, Satin already appears to be a much stronger company than it was a few years ago. Profitability has improved. Asset quality has become healthier. Borrowing costs have reduced, and management has begun transforming the company from a pure microfinance lender into a diversified financial services business. Yet the market continues to value Satin much more conservatively than many larger financial companies. Why? Because markets don't reward yesterday's improvement. They reward confidence that today's improvement will continue tomorrow. Investors are still asking difficult questions. Can Satin maintain good loan quality when the economy slows down? Can it successfully expand beyond microfinance into housing finance and MSME lending? Can management continue delivering consistent growth without taking excessive risks? Until the market becomes convinced about these answers, the company's valuation is likely to reflect a degree of caution. And that caution is not necessarily a bad thing. Sometimes, it creates opportunity. This naturally leads us to one of the most powerful ideas in investing: valuation re-rating. And understanding this concept could completely change the way you look at stocks. Chapter 9. The Investment Thesis. Would you become a partner in this business? After spending hours understanding Satin Creditcare, we finally reached the most important chapter of this story. Not the chapter about profits, not the chapter about valuation, not even the chapter about management. This chapter is about a decision. Imagine someone walked up to you today and offered you the chance to become a partner in Satin Creditcare. Not a trader, not someone buying a ticker symbol flashing on a stock exchange. A genuine business partner. Would you say yes? Before answering that question, let's remind ourselves what buying a share actually means. When you purchase one share of a company, you are buying a tiny ownership stake in that business. If the company grows over the next 10 or 20 years, your ownership becomes more valuable. If the business struggles, the value of that ownership can decline. This simple idea is often forgotten because stock prices move every second on our screens. Those constant price changes tempt us to think we are trading numbers, when in reality, we are buying and selling pieces of real businesses. So instead of asking whether Satin's share price might rise next month, let us ask a much better question. Is Satin becoming a stronger business than it was a few years ago? That single question can tell us far more than any prediction about tomorrow's stock price. If we rewind the clock by 5 or 6 years, Satin Creditcare looked very different. It was known almost entirely as a microfinance institution. A microfinance institution is a company that provides very small loans to people who usually do not have easy access to traditional bank credit. These loans often help families start small businesses, buy farming equipment, expand shops, or meet urgent financial needs. The business had tremendous growth potential, but it also carried significant risks. A poor monsoon, a local economic slowdown, political interference, or weak repayment discipline could quickly affect loan collections. Because of this, many investors viewed microfinance companies as businesses that could deliver high growth but also experience sharp ups and downs. Today, Satin is trying to change that perception. Instead of depending almost entirely on one business, the company wants to build several engines of growth. It has expanded into affordable housing finance, lending to small businesses, sustainable finance, and other financial services. Think of it like an aircraft. An aircraft with only one engine can still fly. But if that engine develops a problem, the entire journey is at risk. An aircraft with multiple engines has a much better chance of reaching its destination safely. That is exactly what Satin is trying to build, a business that is less dependent on any single source of income. Of course, announcing a strategy is easy. Executing it is much harder. This is where investors need to separate stories from evidence. Fortunately, Satin's recent financial performance suggests that the business is moving in the right direction. Revenue has grown steadily over the last few years. Revenue simply means the total income generated from the company's lending activities before expenses are deducted. Higher revenue usually indicates that the business is serving more customers or managing a larger loan portfolio. Other loans it has given to customers. Good asset quality. They also try to estimate how fast those earnings can grow. Suppose there are two companies. Both earn 100 crore rupees this year. At first glance, They look identical. But there's one important difference. The first company has stopped growing. It will probably earn around 100 crore rupees every year for the foreseeable future. The second company is expanding rapidly. Every year, its profits are increasing because it is opening new markets, attracting more customers, and becoming more efficient. Which business would you rather own? Almost everyone chooses the second. Not because it earns more today, but because it is likely to earn much more tomorrow. This is why investors often say, the market pays for growth. In simple words, growth means a company's ability to increase its earnings year after year. If a business consistently earns more money every year, investors are usually willing to pay a higher price for owning it. This brings us to another important term that often confuses new investors: valuation. Valuation simply means the market's opinion of what a business is worth today. It is not an exact science. Different investors can value the same company differently, just as two people can disagree about the price of a house. One buyer may think a property is worth 80 lakh rupees. Another may happily pay 1 crore rupees because he believes the neighborhood will develop rapidly in the future. Both are looking at the same house, but they have different expectations about its future. The stock market works in exactly the same way. Every share price represents millions of investors collectively trying to answer one question: what do we think this business will become in the future? That is why valuation constantly changes. Not because the company changes every day, but because investors' expectations change every day. And this is where Satin Creditcare's story becomes interesting. If you look only at today's numbers, Satin already appears to be a much stronger company than it was a few years ago. Profitability has improved. Asset quality has become healthier. Borrowing costs have reduced, and management has begun transforming the company from a pure microfinance lender into a diversified financial services business. Yet the market continues to value Satin much more conservatively than many larger financial companies. Why? Because markets don't reward yesterday's improvement. They reward confidence that today's improvement will continue tomorrow. Investors are still asking difficult questions. Can Satin maintain good loan quality when the economy slows down? Can it successfully expand beyond microfinance into housing finance and MSME lending? Can management continue delivering consistent growth without taking excessive risks? Until the market becomes convinced about these answers, the company's valuation is likely to reflect a degree of caution. And that caution is not necessarily a bad thing. Sometimes it creates opportunity. Instead of asking whether Satin's share price will double next year, they ask a much deeper question. 5 years from today, will this business be larger, stronger, and more profitable than it is today? If the answer turns out to be yes, history suggests that the share price usually follows the business over time. That doesn't mean the journey will be smooth. Stock prices can swing wildly because of market sentiment, interest rates, economic uncertainty, or global events. But while prices fluctuate every day, business value usually changes much more slowly. That is why long-term investors spend far more time studying businesses than predicting prices. So where does that leave Satin Creditcare? It is certainly not a perfect company. It operates in an industry that naturally carries higher risk. Its future depends heavily on management's ability to execute its ambitious plans. At the same time, it is no longer the company many investors remember from a decade ago. The business appears financially healthier. Its strategy is broader. Its technology capabilities are improving. Its risk management framework has strengthened. And its long-term vision is considerably more ambitious. Whether this transformation ultimately succeeds is something only time can answer. But from an investor's perspective, Satin has moved from being a company that could easily be ignored to one that deserves serious attention. Would I buy it without studying it? No. Would I dismiss it because of its past? Also no. I would put it on my watch list, follow its quarterly performance closely, observe whether management continues delivering on its promises, and allow the business, not market excitement, to guide my decision. Because successful investing isn't about finding perfect companies. Perfect companies rarely exist. It is about identifying businesses that are steadily becoming better than they were yesterday. And today, Satin Creditcare appears to be walking that path. That doesn't guarantee extraordinary returns, but it certainly makes the story worth following. And perhaps that is the biggest lesson of this entire documentary. The best investors don't chase rising stock prices. They patiently search for improving businesses. Because in the long run, businesses create wealth. Stock prices merely reflect it.